Okay. Sorry about that. There we go. All right, so tonight we're going to be looking at the items that are in part two of the intake sheet, that being filing status and household information, meaning dependents that are claimed by the taxpayer. Um, all right, so when we're done with this, you'll be able to know who can be considered dependent and the various filing statuses and how, depending on how you file, how the dependents can affect that tax return. Okay, a dependent is a person other than the taxpayer or spouse who entitles the taxpayer to claim a dependency exemption as defined by the IRS. Now, since 2018, the traditional dependency exemption is no longer relevant due to the much higher standard deduction. It used to be, I believe it was like $4,000 for each dependent that you claimed that your income would be reduced. All that is gone the way of the dodo and probably for good. But by claiming a dependent, you still can be entitled to other credits, both refundable and non-refundable, as well as determining maybe a better filing status. Okay, there are different tests that a dependent must pass in order to qualify, and dependent can either be a qualifying child or a qualifying relative. And they can't be both at the same time. So who qualifies as a dependent? Right there for the child, and this is generally what we generally see. There's five tests: the relationship, the age, the residency, the support, and the fact that they can't file a joint return. So the relationship, it's pretty straightforward. Your son, daughter, stepchild, foster child, or a decedent of those. In other words, a grandchild, or any of them, okay, or your brother, sister, half brother, half sister, stepbrother, et cetera, or a decedent, which would mean your niece or nephew of any of them. All right, so that's pretty straightforward as far as what generally there's got to be some sort of a linear relationship to qualifying as a child. Age, they must be under 19 at the end of the year and younger than you or your spouse if filing jointly, or a full-time student under the age of 24, or at least 5 months out of the year and younger than you, or rather, permanently and totally disabled at any time during the year, regardless of age. Right? That's key once you get north of 24, or under 24, but not in college, and if they're not working or anything like that. If they're disabled, that opens up all kinds of possibilities, which we'll show once we start doing some returns. Okay, the residency must be a U.S. citizen, U.S. resident alien, U.S. national, or a resident of Canada or Mexico. Right, that's key. You know, if your son or daughter are living in Canada and Mexico and you're providing more than half their support, um, or for a certain time, then you can claim them. Same thing with parents. We'll get into that as well. Outside of Canada or Mexico, it doesn't count. Okay, they must have lived with you for more than half the year. All right, there are exceptions for temporary absences. Again, children that are born or died during the year. Again, we have uh, folks that come in, their child is born, on the 30th of December. Well, technically, that's the whole year for a dependency certification, even though they were only, alive for a day or two at the end of the year. Kidnapped children, children of divorced, separated parents. It gets a little complicated with that situation. Temporary absences, again, your child is considered to live with you during periods of time when one of you or both are temporarily absent due to special circumstances such as illness, education, i.e., going away at college, business, vacation, military service, or actually detention in a juvenile facility. And this one's key here, support to meet the test. To meet this test, the child can't have provided more than half of their own support for the year. So that's generally a pretty straightforward situation if they're under 19. Um, when they're, living at home and older than 19, but not a full-time student, That's where it gets a little tricky sometimes. How much did they earn? Did they earn $12,000 last year? Is that realistic to assume that they could support themselves on that? And we'll get into that when we start talking about some of the credits that are involved. And obviously, the individual could not have filed a joint return for that year. Again, it seems like there's a lot of uh, variety here, but in general, our stuff is pretty straightforward. We generally don't go much past son, daughter, first generation. Maybe there we have some single parents who are maybe it's multi-generational, and mother or father is absent, so grandmother is the custodial parent and is claiming their grandchildren. It doesn't happen often, but we do see that. Right now, there's qualifying relatives. So there's four tests that must be met for the person to be a qualifying relative. A first one is they can't be a qualifying child. So a child isn't your qualifying relative if the child is your qualifying child or the qualifying child of any other taxpayer. So again, if the qualifying relative has qualifying child relation or parent, grandparent, uncle, aunt, uncle, etc., then they need to live in the household half the year. Any other relative or non-related person must live in the household for the entire year. So in other words, if I'm claiming my mother, she has to live with me for the full year. Same thing. Again, child can be half a year. Member of household or relationship. A person must either live with you all year as a member of your household or be related to you in one of the other ways listed under relatives who don't have to live with you. Again, this is something we don't really see a whole lot of. If at any time during the person was your spouse, that person can't be your qualifying relative. I mean, some people come in every now and then and you say, well, I want to claim my spouse. Well, no, you can't. You're married. And then you have to decide whether you're filing married joint or married separate. But that there's no uh, dependency exemption there. The gross income test for 2024, the person who you're claiming as a qualified relative must have income less than $5,500. And that's all, W-2 earnings, cash earnings, whatever. The support test. The taxpayer generally must provide more than half of a person's total support during the calendar year. Same thing with a qualifying child, okay, that you're providing more than half their support. Again, if two or more persons provide the support, but no one person provides more than half, it gets a little complicated. Again, I've never seen a situation like that in 10 years of doing this. Again, our stuff is really pretty black and white. There's not a lot of wiggle room in this. It is what it is. The only time that it might be a situation is a multi-generational household, and we'll get into that a bit later. Now, I left this chart in. This is out of the actual 4012, uh, the VITA handbook. There are a number of these in there. I'm not going to go through this because there's a lot of different stuff in here, and I don't think it's worded very carefully. I think if you just revert to these two slides, you're pretty much home free. So I don't want to get caught up on this. Okay, impact of the dependent on a tax return. So here, this is just some of the benefits, but these are the big ones that we see. The child tax credit is up to $2,000 per child under the age of 17 for tax year 2024. The education credit, that's the American Opportunity Credit, can be up to 2,500, and head of household filing status. The standard deduction goes up to 21,900, versus if they were filing single, it's only 14,600. So that alone gives you, the impact of a dependent. We really don't get into the earned income credit part of that until we get to the section on refundable credits. So these are the things you really need to kind of, sort of get a handle on. To be a dependent, the person must be the taxpayer's qualifying child or relative. The child tests are, relationship, age, residency, support, and they didn't file a joint return. So basically, they're your son or daughter or a decedent thereof. They're under, they meet the age requirement, meaning they're under 24, and or in college under 19 if they're not, or they're handicapped. They live with you, and you provide more than half their support. It's pretty straightforward that way. Now, the relative, again, depending on who the household member is, they may have to live with you for the full year. And again, that gross income has to be below that, and you provide more than half their support. Many times we'll see situations where taxpayers claiming they're one or both parents, and all they have is Social Security. So Social Security in and of itself is not taxable if that's all they have. So there's no need to file an income tax return. Clearly, that's probably not providing more than half their support. So again, we don't have that income doesn't get factored into that whole gross income situation. Now, filing status. Okay. Again, there are five filing statuses: single, married filing joint, separately, head of household, and qualifying survivor spouse. Again, the last two involves having a dependent. The first three do not necessarily. It is what it is. Um, the filing status determines the amount of standard deduction as well as other credits that you may or may not be entitled to. So for 2024, the standard deduction for each filing status is single and married filing separate. It's 14,600. Married filing joint and the qualifying survivor spouse is 29,200. Head of household 21,900. And we'll get into deductions to learn how maybe in a very rare occasions someone will get above the standard deduction. Again, other impacts on the filing status, there's the filing threshold where you're required to file, and we'll get into that in another lesson. Exclusion of tax credits and adjustments for married filing separate. Allowance for the full standard deduction for married filing separate. Now, determining filing status. Single, I had mentioned several times, 72% of our returns last year and basically historically are single. So for 3 out of 4, it's going to be a pretty much a slam dunk on what to do there. Meaning they've never been married, or they're divorced, or they're legally separated with a court decree, or the surviving spouse, in other words, husband passes away, but there are no qualifying children to grant the spouse a qualifying survivor spouse situation. So here's an example. Scott's divorce was finalized on December 30th, and he has no dependents. What would be his filing status for tax year? Actually, I didn't change this, but you get where I'm going here. Obviously, it was single because on the last day of the year, he was no longer married. So that's how it goes. Now, if it was finalized in the first of the next year, and he has no dependents, what would be the filing status? Well, then he has a decision of married filing jointly or married filing separate. Again, if there's no children involved, we don't have to worry about head of household. Okay, married filing jointly. If two taxpayers are married, they can file jointly or they can file separately. The IRS, as well as us, encourage couples to file jointly because you get the standard deduction doubles and the higher income threshold for certain taxes and deductions, which can lower the tax bill and get a higher refund, obviously. Certain credits and deductions, most primarily the earned income credit, can't be claimed when you are married filing separate. When you file a joint return, both spouses are held liable for the tax and interest penalty, regardless of whose income contributed to that liability. Now, that one right there is probably the primary reason why our clients decide to file married filing separate. The reason being, what's mine is mine and what's hers is hers. If they come into a marriage and they know that one spouse has outstanding liabilities for a variety of things, back taxes to the federal or the state, motor vehicle issues, court costs, other court fees, or generally it goes to child support issues. Then you want to go separate. Then whoever has those liabilities, their refund will be used to satisfy those liabilities. And whatever the spouse has, she'll get to keep her refund. Now, if one spouse's deaths are causing the joint refund to be offset, the other spouse may file injured spouse form to obtain part of the refund. Federal innocent spouse relief does not protect state refunds. Filing injured spouse is out of scope for VITA. We encourage folks, if it's a real issue there, to seek out the tax advocate or possibly go to an AARP site or again, a paid preparer possibly. There's a lot of things that go into filing a petition for a injured spouse. Again, due to state tax rates or certain other situations, taxpayer may find it lower that their combined federal and state taxes by filing separately. We've had several instances last year where clients asked us to do both. We can. It takes a lot of extra time. You need to put in husband's salary, wife's salary, husband's bank interest, wife's bank. If there's a joint account, then it goes 50-50. The software will then show if they go jointly and if they go separately. And if it's a negative number, they would make sense. They would save money by filing separately. The problem there is then we have to basically redo everything. And it is a very timely process. Again, in other words, to save taxpayers money, we will certainly do that. But in most situations, it's going to cost them more. Another situation that has come up recently, whereas let's say one spouse is all they're collecting is Social Security. The other spouse is still working and has a fairly decent salary. That will if they file separately, then the husband's Social Security will not be subject to any taxation, and he actually doesn't have to file. He will have to file because the wife is going to file married separate, and so there needs to be an offset to that. If one files married separate, the other one has to as well. Okay. No, one, the tax code considers a couple married for filing purposes until they get a final decree of divorce or separate maintenance. Note two, again, we don't have to worry about that. New Jersey is not a common law marriage state, so that doesn't come up. Okay, if a spouse were to die, okay, married couple living together did not have any children or grandchildren living with them, and that the surviving spouse never married. So spouse dies at the end of the year. Uh, Taxpayers whose spouse died during the tax year are considered married for the entire year. Uh, the surviving spouse kind of like married filing jointly. Again, going to next year, they would be single. Okay, spouse dies in their new year. Okay, early in the new year, they were both alive and married on the last day of the year. They can elect married filing joint. Um, Taxpayers whose spouses died during the tax year are considered married for the entire year. Surviving spouse can file married filing jointly. Going forward, okay, they're going to be single. Again, we don't really see a lot of that. We do some folks who come in and the spouse passed away during the year, and we remind them that, in the next tax year, they're going to be filing as single. And that can have a major impact on their tax return because the standard deduction now drops in half. Now, married filing separately qualifications, they can choose to file a separate return, which can be beneficial if it results in less tax owed, or again, they just want to. Some of them, even if they're paying more, they just have this mindset that what's mine is mine, what's hers is hers, and that's the way we've always done it, and we can live with that. And there's generally not kids involved, so we don't have to worry about this other issues which are coming up here. So, I mean, generally, if you file separately, you're going to have a higher tax rate. You can't get the child and dependent care expenses, the credit for that. There's no earned income tax, unless there are a few requirements that they can meet if they're considered unmarried. No American Opportunity credits, no exclusion for the credit for adoption expenses, no student loan deduction, excuse me, no exclusion of interest income from savings bonds used for higher education expenses. And if the taxpayer lived together at any time during the year, 85% of Social Security income is taxed, even if that's all they have. So there are some serious penalties for filing married separate. And the married filing separate filing threshold is $5 of gross income, which means basically you've got to file. And if one spouse elects to itemize, both must itemize. But in the reality, nobody itemizes, so that doesn't really play into it. Again, after all that, it's pretty clear that for most people, filing a joint return is the way to go. So, head of household, again, these are the ones that These are single parent homes that, we see a fair amount of. The taxpayer may file head of household if on the last day of the calendar year they are unmarried or considered unmarried. And we'll get to that idea, that notion in a minute. And they provide more than half the cost of maintaining the household for themselves and a qualifying person who must live in the same household, not just sharing the child support costs. So again, they must meet all three tests: marital status, housing, and a qualifying person. And this is something to, real easy to kind of think of. The last one here. They're generally not married, they're paying the bills, and they're taking care of another person, usually their own child. So housing, the taxpayer paid more than half of the cost of maintaining the home for the year. It only includes expenses such as rent, um, mortgage interest, real estate taxes, repairs, utilities, groceries. Um, Qualifying person, again, a child or a relative, must have lived in a taxpayer's home for more than half the year. And a dependent parent does not have to reside with the taxpayer. Again, that's where that one goes, where not only can they be outside the home, but they can be a resident of Canada or Mexico. Marital status. The taxpayer is unmarried, legally separated under a separate maintenance decree on the last day of the year, or divorced under a final decree on or before December 31st. A married taxpayer can only claim head of household if they did not live with their spouse for the last 6 months of the year and meet the other two criteria. In the case of the qualifying person, can only be the taxpayer's dependent child, stepchild, or eligible foster child. Those last couple items there, that gets into a situation where they may be technically married, okay, but they haven't gone through the actual divorce process yet. And the husband, or in the case of, the father of the or mother of the child, is living with them, but not I'm gonna say, but not they're but not contributing to the household. All right, that's a situation that we see um, a fair amount of times, where it's like someone will come in and they'll say, I'm married, technically married, haven't seen the wife or husband in a long time. He's gone, she's gone, uh, went back to wherever. So that gets into the situation of what's the reality of the situation of the taxpayer. In this case, it's head of household. He or she is providing more than half the support for a dependent person, generally a child, um, and they are the custodial parent. So here's an example. Jeremy is divorced and paid for 100% of the cost of keeping up his home for the year. His son lives with him, and he is the primary caregiver for his minor child. What is his filing status? That's head of household. That's a home run right there. This is a lot. This is pretty much what we see. What we don't see is this. Jeremy is divorced and paid for 100% of the cost of keeping up his home for the year. His minor child lived in the house for 3 months in the summer. What is his filing status? He's single because he doesn't meet any of the household qualifications for head of household. He's not living there for more than half the year. Again, that's usually something we never see. That situation is probably something that was put together by both parents as part of a divorce decree or a custody arrangement, and that's up to them to sort out. All right, qualifying surviving spouse with dependent child. We've only had one of these over the last 5 years. It's basically someone whose spouse passes away, and there is a dependent child or stepchild or a relative or a descendant thereof, and they claim, so they get to be a QSS for 2 years after the year of the spouse passes away. And then they go to head of household. So it gives them a much higher standard deduction for 2 years. And then they go to head of household, so it drops down a little bit. Again, it's the same kind of criteria for head of household as far as paying for more than half the expenses, et cetera, et cetera. We don't really see this at all. I won't really kind of spend any time on that. Nothing's really on the tests about that. So I'm just going to kind of just leave it at that. So impact on the tax return. Filing status can impact a couple different ways. Like, obviously, if you're single, it impacts the bracket that you're in and the standard deduction. Again, depending if your income is $30,000, your tax rate is different if you're single, if you're married filing joint, if you're head of household. Married filing joint allows for both spouses to report their combined income and provides a standard deduction in tax bracket 2 times the amount of a single filer. Married filing separate. Okay, each spouse can file separate, but that puts them in different and generally higher brackets each than if filing single. It also disqualifies from several tax credits, and the taxation of their Social Security goes straight to 85%. They cannot file single if they do not qualify as unmarried. All right, so here's where that last one there's no kids involved, but someone comes in and says, I'm married, but again, haven't seen him or her in years. They just haven't gone through the mechanics of getting a divorce. Um, what is the situation on the ground? Don't know where he is, don't know his social security number. In that case, we're going to file single. And generally, they've been filing single for many, many years, and that's the way we go. Head of household, filing of head of household offers a different tax bracket and a higher standard deduction than filing single, but you obviously have to have a dependent child or relative to qualify as head of household. And again, qualifying surviving spouse with a dependent, again, that's the higher married filing joint tax bracket for 2 additional years. So to recap, there are 5 filing statuses that taxpayers must indicate one when filing on a return. I mean, you can't file a return without determining your status. Single, MFJ, MFS, head of household, and QSS. Some taxpayers who file are a dependent of another taxpayer. All right, that's an interesting situation because what we see there is generally college students or young adults who think they're doing the right thing by filing a tax return because they had a summer job and or they worked at college and they file a return. They don't click on that little box which says you can be claimed by another, and that really messes things up. Okay, so then we got a paper file, mom and dad's return, to indicate that Junior is, they're dependent because he was in college and they need to claim him so they can get the additional credits. Again, depending on what their income is, could be the earned income credit, could be the education credits, et cetera, et cetera. Filing status depends on marital status, dependents that can be claimed, and the taxpayer's living situation. Filing status impacts many aspects of the return, including the tax bracket, standard deduction, and eligibility for other credits. Again, the tax bracket and the standard deduction are all calculated automatically. A number of the credits will involve us to do some due diligence that we'll have to check off different things that will determine whether or not that they actually qualify for that credit. One thing that it does automatically if you're filing single and you're over the income threshold for the earned income credit, you don't have to worry. Yeah, it automatically does that because it's a fairly low amount, and most of our single filers generally make enough income that they're not going to get the earned income credit by filing single, which is only $600, maxes at $600 anyway. All right, so that is it. What we'll be doing next week is income and adjustments to income. I'm going to stop the share right now, and I'm going to stop this.